Hi, Dominique, and thank you again. I think we're all very excited for another session for kind of week ahead, but obviously this one is probably particularly interesting because of the Fed meeting this week. And obviously you've had some pretty unique calls on where you think rates are going over the kind of next years. So let's kind of dive right in. I guess first, maybe just a recap, anything that stood out last week. Obviously, especially into the close, we saw a big sell-off in risk. But any initial thoughts, anything that changes your view on anything or anything that stood out that investors should really be conscious of?
No, I stick to my 8% Fed fund call. It's more a question of when than if in my mind, and if anything, what happened last week and this week makes me think that perhaps it could happen sooner than I initially thought, which was next year. But to come back to your question, Andrew, on what caused, what happened, why the sell-off, I think the trigger was really the release of the employment cost index, which, as we discussed last week, is a Fed's preferred measure and also the more reliable measure of what's going on in the job market, because it takes into account changes in the structure of employment. And so, it accelerated to 1.4% Q on Q. People expected 1% from 1.1% in Q4. And it's really bad news for the Fed because services prices tend to follow wages, especially the ECI, quite closely. So I think the sell-off was despair, as the idea that the Fed would have to really be more assertive with its tightening.
So this goes against the idea that, it was Amazon or earnings, other stuff, like could be a little bit of that, but underneath it, it doesn't look, that.
Well, I mean, definitely, of course, Amazon was part of the story.
Yeah.
But remember that tech stock tend to be highly influenced by Fed funds, simply because of the distribution of cash flow. The big money, if it ever comes, will come in future. So when you have a higher discount rate, i.e. Fed funds, the value of the present value of the cash flow is lower. So for sure, Amazon wasn't terrible, right? It's just that they invested gobs of money into sort of pie in the sky electric truck maker. And so they lost money, but in terms of their overall operations, considering what's going on in the US economy, where clearly, and that's one of the things we saw last week, you have a shift away from people shopping online back to shopping in person. It's not so bad.
I did have one question before we dive in. One thing I feel like I constantly hear from you and definitely from Bilal is, obviously we're not the 1970s, and one of the ways that we're different is, and obviously it from where we are is very different, is the question around kind of workers like power for higher wages or support of having unions behind them. Do you think some of these like small cases, of kind of unions forming something with like Amazon or is this the beginning of something, or you think this is kind of isolated events that probably don't specifically have a big impact?
So I think it could be the beginning of something, but you know that Bilal and I also expect a recession next year. But I think the beginning of something is basically that the labor market is tight, and so people are able to extract higher wages. That said, just to put things in perspective, up to Q4, the share of employment income in total income in the US was falling, and the share of profit was going up.
Yeah.
So what was going on is that there were huge productivity gains made during the pandemic because firms were, experimenting with robotics, IT, but those productivity gains went to capitalists rather than to workers.
Yeah.
So, and also if you look at real wages, they're falling still. I mean, this is the first, since the start of the pandemic, this is the first quarter where we've had an increase, barely, very, very small increase in real wages. So, I think what is going on there is that we have the so-called wage price spiral. And it doesn't mean that workers have a lot of bargaining power. What it means is that inflation has inertia. Because if prices go up 5%, you've got to give some increase to your workers.
Yeah.
Otherwise, it won't be worth paying for the gas to show up at work. And I would think that one big difference with the 70s is that this time around the market power is with firms rather than workers. So if there is a side of the wage price spiral that is stronger, or more influential, I would think it's the prices this time around, while it was the wages in the 70s, because as you said, workers, they had much more market power than they do now. But let me just ask this thing about the recession. This market power of workers and employers, it's also cyclical. It depends on the slack in the labor market or in the economy. And clearly, what the wage data we got told us is that the slack is not there anymore. We have resource pressure.
Yeah. Okay, that's great. Okay, so yeah, so and by the way, if people are not aware, Dominique is going to have a webinar on Tuesday, diving deep into her call for 8% rates eventually.
Absolutely. If anyone thinks it is shocking or silly, it is their chance to say so. So I hope many of us will join us on that webinar.
100%, yeah. Okay, so coming up this week, I guess we'll start with the Fed, and I guess it's, yeah, how do you think Powell's going to handle it, and what's he going to talk about? And I guess in the press conference, is he going to try and convey anything specific?
Okay, so I mean, the Fed, what we already know, because they announced what they are going to do ahead of the meetings. They are going to hike 50 and they are going to start QT. It's all in the minutes. So the more interesting question is, what are they going to do about the long-term Fed funds and the terminal Fed funds? Now, we won't have a new SCP until next month, but we got a hint from, again, the Fed speakers that they wanted to bring the long-term Fed funds, which is 2.4, 2.5%. They wanted to reach it at the end of the year, compared with next year. In the March SCP, they had only 1.9% for end 2022 Fed funds. So that we know as well. The more interesting question is the market has started to test the Fed, not just with a sell-off. So let me get this one out of the way. The Fed put is dead until we get inflation back to the target. Now, the one market development that could get the Fed to relent would be if we had a systemic event. Say, suddenly we discover that, I don't know, a big bank that shall remain unnamed has a much weaker balance sheet than we thought. There is a sort of a liquidity event or a credit event that becomes an existential threat to the economy or to market functioning. That's when they'll stop. But short of that, inflation at 8.5%, they can't mollycoddle the market anymore. So I'll get that out of the way. Let me talk about the other way. The market is almost taunting the Fed, until the ECI actually. the market was pricing 50 basis points at each of the three forthcoming meetings. And after the ECI, the market has started to price a 50% chance of a 75 basis point hike in June. And so the really interesting question is, what Powell is going to say, because there's no question that, you have a few fairly aggressive press conference participants, a CNBC guy, a few of those are going to ask him, Mr. Powell, so what do you say about 75 basis point? And my guess is that he doesn't have the backing of the FOMC or enough personal conviction to say that he's going to do 75 basis points. I think he's probably a bit shell-shocked by the market sell-off. So my suspicion is that, like every central banker, especially in that situation where basically, the Fed has made a huge policy mistake, but the last thing they want to do is to say so. So in those circumstances, central bankers can be as slippery as fish.
Right.
So he's going to try to not say yes or no, but an endorsement of the 75 basis point is not my.
You don't think he's going to try and dispel that possibility?
I think he is going to say something along the line, we will use all our instruments, we will do what we have to. He's not going to say at this stage, I am ruling out 75 basis points, but he's going to hint that 50 is more likely than 75. He's really good at that, Chair Powell,
Yeah.
and at talking without giving any real information.
Yeah. That's kind of the job, right? So,
and so, what do you do if you are in his shoes? There was a big Economist editorial and supplement listing all their mistakes, faults, weaknesses, and so on and so forth. And by the way, saying the terminal rate would be about 5 to 6%. If you are the chair of the Fed and you have the Economist is printing 1 million copies every week all over the world. So you have the biggest, most credible magazine in the world saying that you've really failed. So how do you cope with that? Well, you keep your dignity, you stick to your knitting, you explain that it's easy to do Monday morning quarterbacking. So for our non-US audience, this means, after the fact to debate, how things could have been done better. But he's going to say, and he said so before, because he's coming under increasing pressure from GOP senators on the basis of the available information. And he also said, quite not in those words, but basically, Yellen in 2015 said that as long as expectations are anchored, you don't need to worry about supply shock. So basically, what he implied, he mentioned that without quoting Yellen, of course, but he mentioned that in his confirmation hearing. So it's a way of saying, the previous management left me with a really, really bad manual on how to do things. So he's going to repeat that he's totally dedicated, he's alive to fighting inflation, he's a lifelong worshipper of Paul Volcker, and he will do what's necessary, but no 75%.
No 75, right. And then he changed, I guess the other thing, he's going to talk about QT. Will he? And then I guess, is there anything that there's a chance he suggests something different than the market's anticipating?
No, because they were really explicit in the minute. They gave all the details. They said it would be phased in over 3 months. So they want to do 60 with treasuries and 35 with MBS. If you split 60 in 3, it's 20. So that one is easy. The MBS, it's not that easy to split 35 in 3, but the other problems I have with MBS, of course, is that there will be no redemption because mortgage rates are going up. So the more interesting thing maybe in terms of what they do with the MBS is that the minute said once the balance sheet shrinkage is well underway, we will proceed with outright sales.
Oh, wow. Yeah.
And so maybe you will tell us with more detail what is this once the balance sheet shrinking is well underway. Yeah. Because that's another thing that, they are banging their drum about, which is a difference between the roll-off in security and the outright sales. But in fact, there isn't that much of a difference. So if they really want to let go of their portfolio of MBS, they better start selling now. So let's see if they do that. That's also an interesting test.
And the spread between treasuries and MBS, they want that to widen, I guess.
Well, I mean, so, what they want to do with QT is a little bit of a mystery, because they've been telling us, ever since they got into this QE business, so including in 2017, when they did the first QT, that their main instrument, policy instrument, is the Fed funds rate, not the securities portfolio. So why, QT is turning out to be such a big deal, and also how can they argue that QE played such a big role in supporting the economy, and now turn around and say that QT, which is a reverse QE, is not important.
Correct.
So the thinking is very confused there, which in all fairness reflects the fact that in terms of this operational regime that they have, no one has used it. No big central bank has used it on such a scale before. So let's see, what they say about MBS. But again, it's difficult to interpret, because whatever they say, we don't really know how important it is to them. Like, it's clear that for some members of the committee, so Esther George, for instance, who is really the perma hawk, and by the way, we are going to get a perma dove on the committee, because it looks like Professor Cook is going to get confirmed by the Senate, not on time for next week, but probably for the next meeting. So President George has been arguing for actually shrinking the balance sheet even ahead of starting with the hikes. So I've been wondering if the sort of intellectual establishment in the committee, which are basically the PhD professors and the chair who is allied with them, like basically Lyle Brainerd, has not been using, this balance sheet shrinkage, so QT, as a sort of concession to give to the hawks, which doesn't mean much to her because she thinks it doesn't matter. So
right. I remember you said that.
Yeah. So I don't know. Let's see. This will be outright sales, or a schedule of outright sales of MBS could also be another test of whether the Fed really means business in terms of, shutting down policy easing.
Right. Okay. And then obviously we also have non-farm payrolls. So quickly, what's your views on that? And I guess for data wise, that's the most important thing for the week.
Yeah, definitely. Yeah. So my favorite Friday of the month. So yeah, I mean, what's important there is really, excuse me, participation and wages. And participation, I don't think there is a mystery there. It's likely to continue to go up, especially participation in the 25 to 55. Excuse me, Andrew. I'm in Portland. It's cold there. It's summer in LA and winter in Portland. So the prime age participation has been going up. It's within 60 basis points of the pre-pandemic high, which had increased sharply in the year preceding the pandemic. So that one, I think, is no mystery. The sort of a big surprise would be if it did not increase or went down, which I think is very unlikely. So it's a wages, basically. Whether the wage increase, so we see, which will be the April wage increase. And this is a median wage increase. It's not adjusted for employment composition like the ECI, but whether it accelerates, which would be confirming the information we got through the ECI. So that's really the two to watch. And otherwise, I'm getting a sense that households are starting to borrow, as we discussed last week. So it could very well give a sort of a second wind to the US economy.
Yeah, I remember you saying that. Yeah.
If the headline number turns out stronger than 400,000 or so that are expected, if it turns out significantly stronger, then yeah, it could be a sign that Chair Powell's work has just become that much harder.
Okay. So I guess the other stuff we have ISM, PMIs.
Yeah, again, the consensus expects a small increase, which is possible. Small changes don't mean much.
Right, but still like high 50s kind of.
Yeah, but if you look at the long term, time series, it's down from the from the pandemic high, which is another reason why I have conviction in my call for a recession next year.
Next year.
Yeah. Typically the PMI starts falling well ahead of the recession.
Yeah. And then consumer credit, which I think is something I always kind of find interesting and how that would be taken if we saw a jump in consumer credit. What are you expecting there? And is this an important number or we're still like maybe in a few months? Yeah.
It's super important because this is where this is where you could see the impact of being behind the curve. That look at the mortgage rate, the 30-year is above 5%, but well below inflation, when house prices are still appreciating at close to 20% a year. And that really shows the difficulty of stabilizing the economy when you are behind the curve, because the cost of credit becomes really low because of high inflation. And so credit picks up, demand picks up, and things become that much harder to stabilize. And so, yeah, I'm definitely looking at this number. Though, this is a Fed number. It doesn't include mortgages, unlike the New York Fed or quarterly number, but that's definitely one I'm looking at very closely.
Okay, great. Anything else that you're thinking about, investors should be thinking about for this upcoming week?
No, I think the Fed and the NFP in 1 week is a lot. So good luck to everybody out there.
Last question, the shape of the yield curve, say like 2s, 10s, are you surprised how that's behaving?
So no, I think we've had a bit of steepening, which to me reflects a loss of confidence in the Fed. I mean, because I think I mentioned this last week, but we had long-term inflation BE, so 5-year breaking a 5-year range, at the same time as the 2-year 1-month OIS swap is back to post-crisis, post-GFC high. So people expect that the Fed is going to tighten, but it's not going to be enough to bring inflation.
Right.
I think after the Fed, if the Fed meeting is as I expect, we will probably see further steepening. And that will continue until the Fed basically capitulates and agrees that they need to be much more energetic with hikes, get close to my 8%. And I think that's when the curve starts to invert.
So I understand your last question. So I understand your thought on how he's going to address questions about 75 in June. But do you think the Fed ends up going 75 in June?
No, I think it's too soon.
Right.
I think, if they did 75, it would be an implicit admission that their terminal and rate is too low. And I suspect that Powell probably is there. I mean, based on comments made, including the comment about, I've just followed the textbook prescription for supply shocks. Also, he's starting to talk more about demand shock. So I think he's getting there, but I think his committee is definitely not there. And Brainard, definitely not. And also, as I said, he's getting a super dovish number for June. So
Right.
I doubt it. I could be wrong as always, but it's not my base case.
Okay. Okay. Awesome. Okay, cool. Well, enjoy the rest of the weekend and good luck, everyone. And as mentioned, please, everyone join us for the Dominique's webinar on Tuesday. Thank you. Bye.